All right. Good evening, everyone. Shasika here, coming to you live and in charge of CEO Hustle Financial Solutions, where we help you retire before you expire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. And we're going to come to you really briefly on this evening, about 10 minutes, to go over the top 10 reasons why individuals are actually owning life insurance in retirement. Why would you own a life insurance product in retirement? So let's just deep dive into it really quickly. Want to see if we can just kind of dispel some of the myths as it relates to retirement planning. Guys, I actually specialize in retirement planning, helping people design a tax-free retirement income that they will not outlive. The biggest fear outside of death is actually dying and not having enough. I mean, living longer than the money that you actually have. Let's just be clear. So, that can happen. There are people that are in their 70s and their 80s. They're actually returning to work because they do not have any more money. And so we don't want that to happen to you. That is not a good deal. So how do you structure that so that you can be able to have tax-free income with benefits? In other words, living benefits. If you have a heart attack, cancer, stroke, dementia, any type of long-term care needs, how do you structure, a policy to where you be able to have that for you in the event that you have any type of medical challenges? That's something that a lot of people don't plan for, but unfortunately, 69% of bankruptcies are caused by medical challenges. Nobody plans for it, but it happens, unfortunately. So to make sure that you're covered, we want to take a look at that, because at the end of the day, the typical, or I should say traditional employer plan does not have medical benefits, right? It doesn't have living benefits. Let me be clear, living benefits. So living benefits is something, as I just mentioned, heart attack, cancer, stroke, dementia, chronic, critical, terminal illness, anything that fits one of those categories is really what we're talking about tonight. But one of the main reasons people use whole life more specifically, and I know you all might be saying, the elephant in the room is an IUL. But tonight we're going to talk about whole life, not an IUL. We can talk about that another night. But welcome to Life Insurance Awareness Month, because that's what September is all about. And I am pretty regular on here. So tonight I wanted to start off by talking about the whole life more specifically, and why owning a whole life, because I know I always talk about IUL. So number one is the freedom to spend other assets in retirement. In other words, you often hear people talk about a banking policy, or how can I become the bank? Well, that's really important to understand, because a typical bank is not going to give you the return that you're going to be able to get from, of course, a whole life policy, right? Now, whole life policies, they are very conservative in comparison to, say, the IUL in retirement. However, they give you the flexibility around having access to 100% of your money from the beginning when you put it in. Different from the IUL, where you have a surrender charge, right, in the beginning years. Although long term and over time, your rate of return is going to be higher with an IUL than it is with a whole life policy. So let's just take a look at that. So, you don't have to go and have to borrow money in retirement. You can actually have your own access to your money. Let's say if you have a medical challenge or an emergency fund, and you just want to be able to access your funds in your whole life policy, that money is actually being used twice. Somebody just say twice. Look at your neighbor and say twice. Okay. So while the money is compounding inside of your account, you can actually still use it to do whatever other investments you want to do, i.e. real estate, stock, mutual funds, crypto, whatever you want to do risk-wise. You could, if you wanted to leverage what you already have saved inside of your policy, and the money would still be compounding in your policy as if you never took it out. Now, in the first 12 months of that, you can actually have an interest-free loan where there's no debt to income challenge. There's no credit hit. You have access to your money. You don't have to ask permission. It's your money. You own it, and you're beating the bank, because the compounding is always going to be greater than what you have inside of any, traditional bank account, right? Now, of course, some carriers is doing very well with whole life and how they're returning a compound amount for you, up 6%, 8%. I've seen some different amounts out there, but the goal really is to have access to your funds twice, okay, to be able to leverage. Now, freedom to spend is the number one thing. You have access to that money, wherein, let's say you wanted to retire at, say, the age 50, right? And that's very, very much doable. A lot of people do that. If you have, say, your money with an employer plan, you have to wait until you're 59 and a half without penalties, right? So if you have a whole life, people are using that money to be able to access until they're ready for their, Social Security or that other supplemental income if it's still around. Again, economists are saying anywhere between 2025 and 2032, there is not going to be any Social Security. Now, we don't know how true that is, if that's even going to happen, but we do know we have to plan for the unexpected, and taking care of your older self is a part of that plan. So that's the number one reason of the 10 reasons that we're going to talk about tonight. Number two is, of course, Social Security benefits for self and others. I mean, let's be clear. You don't know what the amount is going to be unless you have went to the Social Security site and figured out what is your Social Security, and you can do that. Now, let me look at the comments. I'm sorry, because I'm on a couple different networks. But basically, you can look at your Social Security and make sure that you have enough Social Security benefits and find out what your gap is. So, gap meaning whatever you have today, you know that you're going to have to pay taxes on your not on your Social Security, but you're going to have to end up paying taxes on any money that you withdraw from any retirement account that you have. So you're going to have to pay local, state, federal taxes on that money. Let's say if you have a 401k, 403b, 457, unless you have a Roth IRA. Okay, that's the only one that's going to allow you to not have to be concerned about taxes in the future because you've already paid those taxes. Now, if you have a gap of what you're making today and what you plan to have in retirement, that's where you can make that gap up inside of a whole life policy and be able to increase your income and supplement your Social Security or your pension if you have a pension. Most companies today aren't even offering that. So that's the second reason why a lot of people are actually using whole life policies. Of course, the third one is going to be for tax diversification and making sure that you have tax deferral for the life insurance cash value. In other words, your money's actually going to grow tax free. Okay, those other accounts, like we said before, they're going to have taxes. So that is the third reason why most individuals are going to be able to use or would like to use, let's say, a whole life policy. Not only is it growing tax free, and so that's less money that they have to, pay, but they'll be able to have that money to be able to use for other reasons, and all these different things that's going to occur in retirement that a lot of people don't necessarily plan for. Well, over time, that tax free growth is a significant difference. So I often tell people, you look at what you have going on with your mortgage and your car expenses and those types of things, but your biggest expense is going to really be some type of tax challenge, your tax bill, the tax bill that most people don't even take a look at, right? So let's just speak about that for a quick second. I went from literally paying for taxes, right, to having a better strategy, okay, with my tax accountant, and end up getting back because of basically the tax code, right, is written for the business owner. Let's be really, really clear. It's not written for the W-2 employee. Nothing wrong with having a job, but if all you have a job and you don't have any tax diversification, right, then there's a challenge because you're not able to have tax advantages that you're susceptible to, right, if you have some type of business. So again, that's why people are getting what we call a side hustles. That's why there's a great resignation. People are starting to learn how to do money. They're understanding how money works. So they're saying, I'm going to resign. I'm going to go and start a business, or I'm going to get a business on the side because I realize that all the money that I can make back from my tax diversification or my tax advantage from having a business, with there being 475 deductions that you can take, right? Actually, that was before COVID. After COVID, it was like 625 or more. It just continues to be a lot more deductions because of being a business owner. So they decided they wanted to take advantage of that tax diversification. But again, having a whole life product is a part of that as well. Again, asset allocation is number 4. Okay, so whole life insurance is not subject to market risk. Let's talk about that. A lot of people are cringing because they are losing money inside of their accounts. 20, 30, 40, 300,000, 500,000. This depends on what you have, but they're losing a lot of money. It can be halved, whatever you have inside of your account. So yes, the greater the risk, the greater reward, but also it can be the loss. So the older they become, the longer they are. And, they want to understand that the risk tolerance is actually should be lessened the older they become. Okay, so let's just be clear. So the younger you are, you have more time to rebound from a market loss. But the goal is to make sure that you can rebound in your lifetime. Not everybody's able to rebound from their loss and their lifetime, right? Depending on how their money was structured. So asset allocation and understanding, 10% of your portfolio, it could be pretty significant if it's high risk, if that's where your funds are. Now, we're not giving any financial advice. I have to always say that, right? I'm not necessarily giving you a consultation right now. I'm just giving you some facts of, this is what is happening, and this is why people are doing what they're doing with their money, and why they're making these types of decisions, and why, whole life policies are being used for the retirement account. They want to have access to all of their money as soon as possible so that they can be able to use it for whatever they want to continue to diversify their portfolio with the cash value that is inside of their whole life policy. Cash reserves for emergency, that's one of the foundational. We often talk about this thing called generational wealth, and we get to the legacy and all that part, but what about the foundation? The foundation is something that a lot of people don't understand and are missing. Think about a pyramid, or think about laying the foundation for a home. The base is important. If that structure is not right, that house could fold, right? And so at the end of the day, the foundation for your assets, the foundation for your finances should always have some type of life insurance product, because it's going to have stability. There's no risk, right? If you have the right type of life insurance product, there's no risk, and you also have the cash reserves in there, right? So that is the reason why people have a bank account, or some type of credit card, right? But you can do the same, you can accomplish the same thing with a bank account and a credit card with a cash value whole life policy, because you don't have to have the credit to take out your emergency loan from your cash reserves, and your money is going to be growing just like it would be growing inside some of these other types of accounts, to be honest with you. And it is really about your risk tolerance. The more risk you're willing to have in terms of let's say you want to look at the growth for your money, and you want your money to grow at a certain rate of return. Well, we know that there's certain rates of return historically that a whole life policy has been able to give versus an index universal life, for example. That will determine which one you would get, right? So dividends are not guaranteed. They're not guaranteed to be paid out. And let's say if you have a whole life policy that has dividends, those are not guaranteed. So just being careful with that and understanding that that is not guaranteed. That is depending on the performance of that whole life insurance carrier, right? And of course, you can look at the historical data for that and see, how they've been performing. But on the other hand, the S&P 500 has been performing in the last, let's say, 40 years. 8 years of that was negative returns. In those years you wouldn't have lost anything, but you would have actually been able to keep what you had in your account. And then I'm talking about an index universal life policy, okay? In an index universal life policy, it actually performs based off of the S&P 500, right? So where there was a loss, you would not have cringed, and you wouldn't have been crying and folding and all these types of things, because you would have known that, rest assured, you would have your money in there, because it doesn't matter, because your money is not, the floor in an index universal life is going to be zero no matter what the market does. But when the market goes up, you get to participate in the market, right? You get to and I say participate in the market, you get to participate in the credit returns that the market gives. Let's be clear about that, because your money is not tied in the market. Your money just parallels the performance of how the market is doing. Okay, so if the market does well, you get credited inside your account, you make money. The market does not do well, you don't get credited, right? You just won't lose any money. So there is no risk when it comes to the index universal life. All right. So now, whole life policies, cash reserves for emergencies is another reason. There's no required minimum distribution. Okay, unlike your traditional retirement account, this is number 6. Unlike your traditional retirement account, there is no required minimum distribution. That's why people love it, because it doesn't matter. You can keep that money in and let it grow and grow and grow. You don't have to take it out at the age of 70, right? So that's something to really be to understand. We kind of already talked about number 7. We're talking about accelerated death benefits and making sure that you have that. When we say accelerated death benefits, it's also known as living benefits. And again, chronic critical terminal illness. If you have any of those while you're in retirement, instead of you going bankrupt in your retirement account to have to pay for medical bills, you can actually access your death benefit. See, most people see life insurance as just death benefit, but it's life insurance for a reason because you can use it during your life if you have the right type of policy, right? So the life portion of that is going to be where you'll be able to access those funds for, like, again, if you have any medical challenges that you have to pay for, you can do that during using that accelerated death benefit rider. That's what it's called, because life happens, right? It does happen. So we want to make sure that we are clear about that benefit and what that can do for you. It gives you peace of mind, no out-of-pocket medical expenses at the most difficult times of your life, when there's a critical or chronic or terminal illness, cancer, heart attack, heart attack, dementia, stroke, those types of medical challenges that people have suddenly. And, you can access your death benefit and be able to pay that off. You don't leave a big bill. Now, supplement to college savings funds is another reason why people have it for their children, right? They may want to have some type of supplemental college saving fund. So let's say you have a 529 plan, for example. A 529 plan can only be used for the college. It does give you some tax breaks, but however, what if your child doesn't want to go to college? Or what if your child wants to do a business, or maybe they don't finish college for whatever reason? Those funds are for that reason, right? So at the end of the day, people who have flexibility with the money that they have in their cash reserves as it relates to the college fund as well. And oh, by the way, when you try to go to fill out your FAFSA for your child to get some type of grant, they will take into account that income for whatever you have inside your 529. So people don't want that disclosed, and they want to have access to more grant money. They don't use a 529 plan. They use a college fund, so that's not something that's going to be shown. All right. So very, very clear about that. Now, potentially no contribution limits is something we have here. So let's talk about that. So taxes. Roth IRA, everybody knows about that, but the way that you get around, of course, paying taxes and making sure that you do it the right way in any policy type is going to make sure is to take out a loan and not withdrawals. A bunch of withdrawals is going to send a red flag, or if you put in too much money, right? Depending on what type of policy it is. Right now, we're talking about whole life. So an example here, you can definitely design your income, to be able to take out loans based on when you need it. Right. But you want to make sure that you're careful about not taking out withdrawals, because if you take out withdrawals, that's different from a loan. Right. The loan is the reason why you don't pay taxes back. So, yes, just understanding that as well, and what that amount should look like. Now, the last one, number 10, of course, is that there's no pre-age 59 and a half, 10% tax penalty. So if you take your money out, you're not 59 and a half, you may be 55 or 50 or whatever age you are, as long as it's in a loan, again, you don't have to worry about that. There is no, now I need to go back to number 9, be more clear. I apologize. No contribution limit is what we're talking about in number 9, meaning that, of course, with a Roth, you have $6,000, right? That's the most that you can put in. But with your policy type, you can put up as much as, your MEC limit. And let's be clear, your MEC limit is your modified endowment contract limit. And the IRS says that's the most that you can put in without treating this like an investment. So if you're a person that's trying to stuff a whole lot of money inside of an insurance policy so you don't have to pay taxes, be careful and just make sure that it's going to be proportionate to your MEC limit. And your MEC limit is actually proportionate to your death benefit. So the higher your death benefit, the higher your MEC limit. The higher your death benefit, the higher your MEC limit, your MEC, modified endowment contract, which is what the government says is the most you can put inside of that policy. All right. In a given year, a given single premium payment amount, and over 7 years of that. Like let's say the first 7 years of that account, you can put up to a certain amount inside of it. So those are the different criteria that determine whether or not you have exceeded your MEC. But the carrier would let you know. A good carrier is not going to let you put too much in. They will stop it. They will refund you. They will do whatever they can to keep you from MECing if they're a good carrier, right? So yes. So understanding that. So again, the 10 reasons why owning a whole life insurance in retirement is very important is, and I'm going to go over them. I'm not going to go through them again, but I'm just going to list them one more time. Number 1 was freedom to spend other assets in retirement. Okay, so number 2 is increasing your Social Security benefits for self and for others. And number 3 was a tax diversification. Number 4 is asset allocation. Number 5 is cash reserves for emergencies. Number 6 is no required minimum distribution. Number 7 is accelerated death benefit rider for when life happens. Number 8 was supplement to college savings funds for your children. Excuse me. Number 9 is potentially no contribution limits, right? Minus basically the MAC limit is your contribution limit, right? And then finally, number 10 was that you don't have a pre-age 59.5% on your tax penalty. So those are the top 10 reasons why people absolutely will get a whole life policy all day long for their retirement account. Again, it is Life Insurance Awareness Month. So we wanted to kick it off at least with some life insurance. We're still having conversations about the annuity. So if you want to be a part of that, definitely join us. Go ahead and follow us on YouTube. Click the bell so you know when we go live. We don't have a set schedule. Our goal is to go somewhere between 3 and 9 to make sure that we get the information out based on our schedule. But if you're on YouTube, you'll know when we go live. You can click the bell. Now I want to see if there's any other questions. And let's see. I got a lot of. Let me see if I can turn that over. See you guys over here. See if there's any questions. I want to make sure I answer all questions on Instagram. And there any questions on Instagram before we move? Hi, TNA Financial Group and the Real Soup and whoever else is on here. I can't see the names. All right. I think I missed a question. LIAM 2022. Absolutely, Mr. Ramos. And okay, no questions on this one. Oh, it says, good evening, Queen. Hope all is well. Yep, all is well here. All right, so I don't see any questions over there. So definitely wanted to make sure that we're not long and strong. Was giving you the data that you need. We'll be talking about annuities. Want to see what questions you have on annuities. So definitely send your questions. If you have any questions on annuities, please go ahead and send that to me so that we can make sure that we conquer that and answer those questions for you. And we'll continue to have those conversations. If you don't have your retirement planning guide, definitely go ahead and download your retirement planning guide. And workbook is a checklist. It's going to help you to take action on your retirement. So just go to shatika.com or a link in bio, depending on which social media platform you're on, shatika.com. You can go ahead and download that for free. And yes, so Saturday we'll be doing a webinar at 10 a.m. So if you want to be a part of that, comprehensive webinar, because I know we do a lot of drive-bys on social media, but if you want the comprehensive, all-inclusive, here's what it is, definitely join me for the webinar on Saturday morning at 10 a.m. Eastern Standard Time. And let's see, no questions, just like the pearls though. Oh, thank you. Thank you so much. All right. Well, I don't see anything over here, so I'm going to go ahead and end this broadcast. And I'm Shatika Hesser, CEO of Hustle Financial Solutions, where we help you retire before you expire. If that is your desire, we're the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive, which is the biggest fear besides death. All right. God bless you. Have an incredible day. We'll see you at the top.